Well, hello there. Welcome to the PRUSKOP Podcast. My name is Megan Prusko, and I'm a realtor here in Edmonton, Alberta. I love talking about all things entrepreneurship and investment. I ask a lot of questions, so a podcast just felt natural to me. Today, we are talking to our very special guest, Shabir Madhas. He is a residential and commercial mortgage broker. We talk about the difference of using your mortgage broker versus your financial advisor through the bank, what to expect when you're applying for a loan, how to pay your mortgage down faster, different mortgage products that both investors and primary homeowners can use to their advantage. One of those products literally just got released 2 days ago. I hope you enjoy the conversation just as much as I did. Well, hello, Shabir. Welcome to the PRUSKOP Podcast.
Thank you so much for having me. I'm so excited to be on a podcast, especially with you as well.
I'm so pumped for this. I just know the conversation is going to be incredible because every time I talk to you, it's just an absolute pleasure.
Oh, I appreciate it.
Today, we're going to be talking about the advantages of using a mortgage broker and different mortgage products you can play with for our clients so that they are getting the best financing structure for what their goals are. Well, I want to kick off and say a little bit about how we met. So your friend Stephen Boodoo actually reached out to me on Facebook and he wanted to learn a little bit about MLI Select. And then I met with Stephen and you for lunch and we had a great time. I really enjoyed it.
Oh, we did. Oh, yeah.
Yeah, I'll have to put the picture in here so that everyone else can see our big smiling faces. You're a mortgage broker. How did your career start and why are you passionate about your work?
I originally was in construction and
I didn't know that.
I had a small little construction company I was doing in 2006 and 7. I worked for a company and we were doing all new home builds in the Edmonton area. And obviously when you're in new homes, you always see realtors, you see people walking in and out of houses, you're talking to sales reps, they're asking, oh, when will this be done? And then my business grew from that. And then I had such a big contact list of realtors that would say, hey, Shabir, we're listing this home. Can you quickly paint this door? Can you fix this shelving? Can you put a mirror in for us? I'm like, yeah, sure, no problem. So then my business grew, my client list grew, and people would be asking me, hey, a client in a home, for example, I'm doing a renovation. We want to sell it. Can you refer me a realtor? I'm like, yeah, here, go ahead. Here's this person. Who doesn't fit you? I got another 50 of them. Don't worry about it. We'll find you somebody. And then our industry got very competitive. Small guys like us do not survive out there. And we can't be competitive. And people are like, well, we got a quote from another person that can do it for half of your cost.
I think small guys in construction can only be competitive if you're cutting corners, which will really reflect in the quality of your work.
Yeah, and I wasn't willing to do that. I didn't want to do that. So I took a little break for a year and I said, okay, what am I going to do? And I said, you know what? I'm going to be a realtor. One of my realtor friends told me, he goes, you're an idiot. I was like, why are you saying that to me? He's like, first of all, you know how many realtors, why do you want to work against them when you can work with them? So I thought to myself, that's pretty smart. I'm like, you know what? I'm like, what should I do? Be their assistant? He's like, no, be a mortgage broker. They have the clients. You find the financial situation for the clients. You like to talk. You love numbers. This would be a good thing for you to do. So I said to myself, okay, let me look into it. So I said, fine, this is something that works for me. I'm already in the real estate industry, even if I'm doing renovations. I've been doing it for 10 years. Let me hop onto this side and see how it goes. And it just picked up. It just started going. The sky was the limit then.
You mentioned there's a lot of realtors. So in the Edmonton area alone, there are 4,500 realtors. And yeah, there is a lot of competition, but there is a lot of business out there. As you were saying, if you're a mortgage broker, you're further along the pipeline. So us realtors, we're the one that are filtering clients for you. So you don't have to do as much as the lead gen.
Yeah. But to keep that going, we have to do our job for you. Mm-hmm. We have to satisfy your needs as well as the client's needs. Okay. Yep. So it's a good balancing act. It's not something that you can just jump into. You got to have that personality. You got to have that confidence in yourself. You got to know your products and services. But the most important thing, you got to know your client. You have to have some sort of connection with that client, because anybody can just talk to a client and, you're my client. That's it. But if there's no personal connection, this is my personal view, there's no personal connection, you're not going to win that client's business. You might get it for that time, but it ends. In our industry, yours is mine, it's longevity of that client. They're going to refer you a friend. They're going to buy a second home. They might have children that they're going to pass on to you later on. Just one of those things that you have to be very personable in your industry.
And
So
just as an example of how seriously I have personally witnessed you take my clients, your house literally burnt down and your response rate, like literally burned down, and your response rate was just super quick with my clients still. And you didn't even tell me that it happened until I called you about one of my clients. And you're like, yeah, this is happening. I'm like, I never would have known because you were still so on top of it. Like, if you were due credence at any point in your life, it's when your fucking house burns down.
I was literally at my desk in my house working on a deal. I think it was with Mark's deal,
Mm.
and working on that. And I'm banging on my door. Your house is burning down. Everyone got out. I think 2 days. I think I literally took a day and a half off, and right back to work. I'm like, it doesn't matter. It'll take care of itself. We just
You're
got to keep
just
on
a
going.
beast. Like, you're just a beast. Holy. So that's why you're in your basement right now, because you have a new home and you're
Yes,
sitting on some cardboard boxes to get this episode done.
and that's why the background is blurred. Because if I showed you unblurred, it would be a disaster. We're not even going to talk about it. This is another podcast.
What is a client story of yours that makes you smile to this day, and how did you help them?
I do residential and I do commercial as well. So
Mm.
for one residential one, it was a newcomer to Canada. People migrated here from India. Worked, I think, three jobs. It really hard. They went to their bank. The bank denied them. Said, no, sorry, you don't have enough credit. You're just too new to Canada. We don't want to take on that risk. So my realtor friend said, hey, Shabir, can you just take on this deal? Could you just help them? They've lost the confidence. They've migrated to a new country thinking this is the best thing for them. They want to buy a house. And we got the deal done. We structured it in a way. Obviously, there's programs out there for newcomers and so forth. These people, just a look on their face of owning, and it wasn't a lavish, it was a 2-bedroom condo, nothing spectacular. But for them to own that property and have it in their name with whatever savings they had. And it was their own personal savings, nothing gifted from family or anything like that, but it was their personal savings. We had a few issues, we overcame them and we did it. But just to see those clients' face smiling, and they still calling me to this day, happy Christmas. They're Hindu, so Diwali comes up, they send you messages. And that makes me feel like I'm doing my job properly. I'm satisfying people's dreams, because the mortgage broker, people think, oh, you're just doing financing. No, you're giving me the opportunity to make your dream successful. That's what gives me satisfaction on that. On the commercial side, again, people buying businesses. My first ever commercial deal, which will always be my favorite one. I got a client. They want to buy a Holiday Inn hotel. Okay, I'm totally new to the game.
That's a pretty big case for your
I
first
was
one.
I wasn't gonna say no.
Holy.
I wasn't gonna say no. It got done 9 months later, and I learned a lot, and that's how I got into the commercial game. I literally just that deal fell in my lap. I was at a hockey game. My cousin's best friend over a couple of beers, just talking, having. And he's like, "Oh, I'm buying a hotel." I was like, "Oh." I opened my big mouth. I'm like, I could probably try to get you the finances for that. He's like, so got rid of his other broker, like literally over the text message at the hockey game, and started with me, and then
You're a financial homewrecker. You're just stealing people's
I
clients.
definitely am.
That is awesome. Something that I was talking about recently is us as realtors, or you as mortgage brokers, just in the residential world. We are helping our clients and we are joining them on their last page of their most recent chapter of their lives.
Yes.
And once they get their home, they flip the page and we'll keep in contact with them. But like, we are a part of their milestone. And whether it is a sad milestone or a happy one, it is a big moment. And that's not something I handle lightly. It is an honor and a privilege to help people and see that you can actually make a difference in their lives.
It gives you a good feeling inside when you know you're completed it, and when you give them the keys, and it's the best feeling in the world.
Oh, it's so good. All right, enough with the mushy gushy stuff. Let's get into some fun stuff, learning about what exactly mortgage brokers do. So what is the difference between a mortgage broker, which you are, or being a lender?
Right. So you have a mortgage agent that works for a typical bank. CIBC, RBC, TD, the major fives, right? They can only sell their products and services, and they're mandated by their guidelines of what you can use to qualify to get a mortgage. When a client comes to us as a broker, we have a whole group of lenders. So we have 35 aiming from the typical A side to a B side to private lending. So for us, we can take that client, find it where they best fit. And obviously, we have better policies and guidelines that we can use to help them qualify. So, say for example, a client already owns a home. Now he wants to go and buy a second home. He's going to live in it. Okay. At a typical bank, they're only going to use 50% of the rental income, and that might not even help them qualify. For us, we have certain lenders that can go all the way up to 95% of that rental income to help them qualify. Brokers are 24/7. If you go to a branch level, they're Monday to Friday. I'm not saying all of them, but most of them. That's what our clients are telling us. Like we call up our agent at the bank because we bank with them for 25 years. 9 o'clock, we'll get a call. At 3 o'clock, we try to call them. They're not answering. For us, our customer service has to be 24/7. So the difference is we have more lenders, we have more access to special programs and services that these agents don't have. And those agents that are in the bank don't have to go through a licensing criteria,
I
regulation
never thought of that, but
as we do. Yeah, so we have to get a license, just the same as realtors. They have to get a license. But the agents at the bank don't because they're an employee of that corporation. We are independent, right? Clients feel better that we're negotiating rates through multiple lenders and not just one lender. So if you go to CIBC, you're stuck with whatever their rate they have. Okay. If I go, you bring it to me, I come to any lender that I can choose, which I think your client fits. If I find a rate somewhere else, I have the opportunity to take that file somewhere else and get a better rate.
I had this one client, they were looking to sell their house and buy a new one. And their financial advisor said, you can't buy this place until you sell this one. And I'm like, okay, well, what about a bridge loan or this option or this option? And the husband, he looked at me and he was like, how come my realtor is teaching me this and my financial advisor isn't giving me these options? I'm like, well, that's why you should have used Shabir, and that's why you should talk to him now because he knows about all these tips and tricks, which they're public knowledge.
Yeah, exactly. It's not a trick or anything. Like you said, it's just product knowledge.
Yep.
The lenders are telling us you can do this, so we structure it this way to get them approved. Okay, we're not lying, we're not deceiving, doing anything like that. We're presenting them what's in front of us. But again, when you go to a typical lender, a financial advisor is not a mortgage broker. A financial advisor is just being taught what their bank is telling them to do.
Yep.
And then all they're doing is packaging the deal together and sending it up. For us, we're packaging it from the beginning to the very end, and even after that. 3 months after, I'm going to contact you. 6 months after that, I'm going to contact you. A year after, I'm going to see how's things going. Do you have questions for me after the case? You know, and that's why brokers are becoming more popular than actual agents in the bank.
If I was applying for a mortgage, Shabir, do I have to pay you for my pre-approval or for your services?
No, our services are free. We're not going to ask you for no money. Okay. We get paid by the bank. The bank's going to compensate us for bringing the client to them. Right. And there's a myth out there. People are like, oh, brokers are charging a 1% fee or a 2% fee. The only time we've ever charged a fee would be when we go to a private lender. And that's special circumstances. People need that, right? But we got to get compensated for our work to get you that deal, do all the calling around, the negotiation, get all the paperwork to this private lender, and go back and forth and make sure everybody is satisfied with that. And that's, again, private lending is a temporary solution. It's not a long-term solution. It's a very short-term solution to get you back to where you should be. And sometimes the reason you go in private lending is because clients maybe change jobs. It's a quick close. They want the property. You don't want to lose it. And the only way they can do it is they have the 25% down ready to go. And they just want to close the property quick. And then we just refinance it back to normal once whatever issues they're having has been resolved.
So if I'm your client and we end up going with CIBC as our lender, I'm not paying you my mortgage plus X%. CIBC will give you a portion of the loan value to compensate you.
Yeah, the banks pay us.
Yeah.
Whatever they want to pay us, whatever it's going to be, they'll pay us.
Mhm.
So it's in our best interest to make sure we get you qualified and got your property and move on, right?
Yeah.
It's like it's full commission, just like as yourself, right? You're trying to satisfy your clients' needs and everything. The way you get paid is when the properties get sold.
Mhm.
Same for us. We get paid once the mortgage is funded,
Is
and we're not
there
going to.
a really simple calculation people can use just to get a ballpark of what their purchasing power is without talking to you?
There's a lot of online calculators and stuff
Mm,
like that, but that's just a generalization.
yeah.
So you're gonna say, I make $100,000 a year. I want to buy a $400,000 property. The online calculator is gonna spit out, yeah, you qualify for this much. But they're not taking into consideration all your debt every month, the property tax on the property, the heat that's also incorporated in the calculation. And are we going to amortize it over 25 years? Are we going to amortize it over 30 years? There's so many factors in it. So when clients go to me like, oh, well, I went on this online calculator from XY website, and they said I qualify for $500,000. But then,
Mm.
Shabir, when you're doing it, we're only getting 350, and I have to explain to them this is the reason why. The rate you put in a rate of 1%, and current market rate is 5%.
Yeah.
So there's a huge difference there.
Getting one of those online calculators, it can be good to get like a really soft idea, but don't take that number to heart because that's not guaranteed.
I don't trust those online calculators,
Mm,
right? Because some of them are associated to brokerages or something, right? Or like
mm.
an online mortgage company. And they're just trying to bring you in. And then they bring you in and they already have you. And then you're like, okay,
And
well,
then
I'm
they
already
break your
here.
heart.
Yeah. And then they're, well, okay, sorry, you don't qualify for this because they're going to tell you the same thing I'm going to tell you. And then you move on to, okay, fine, I'll go for something for 350.
So,
But that
what
initial,
are those like hidden factors that people often overlook that will affect their purchase price?
yeah, so the income, their debts per month, right? What if they had some credit issues back? What
Mhm.
if they had some collections? What if they had a bankruptcy? They did not. The computer's not asking you for that. A lot of people in Alberta were seeing that a lot of people going to consumer proposals, which is one above bankruptcy. Okay, so they're thinking they're consolidating, and these consolidation companies are there just to make that money. They're bringing in those clients and saying, yeah, just do the debt consolidation, you'll be fine. After 2 years, you can apply for a mortgage again, or once you pay it off, you're fine. But that's not the case. You need a 2 year cooling off period, and within those 2 years after you've gone off the consumer proposal, you have to reestablish your credit because you have to show your credit worthiness back to the bank. Because if the bank doesn't feel secure with you being good with your credit, they're not going to lend.
Yep.
You're too much of a risk to them
Mhm.
because at the end of the day, they're a business. They're in it to make money. They're not in it to be your friend.
The clients are complete strangers to the bank. So all they have to go off is your numbers. Even if it was your friend, like if CIBC was my best buddy, but he knows that I have a track record of living paycheck to paycheck and I have 15 grand worth of credit card debt, even if we did have a personal connection, they're not going to trust me.
No,
It's like really having, your finances stacked up and at least all of your documentation so you're getting a clear picture.
yeah, of course. It all ties into your employment. Are you employed? Are you business? Are you self-employed? Are you a professional, like a medical professional? Like there's all different types of categories of clients
Mm-hmm.
and their risk rating. For example, dentists, the bank will throw money at you because you're a recession-proof business. Nothing's
Mm-hmm.
ever going to happen to you unless you pass away. Like you'll always be in that industry. You'll always have making great, great, great money compared to somebody who's working a minimum wage job.
So we talked about a little bit why you should get a proper pre-approval because if you use those online calculators, you're probably being misled. But another reason is getting your accurate purchase price before you start shopping. You're not going to get your hopes up, or maybe you'll realize, oh, I actually have a lot more purchasing power than I thought. And
Correct.
it'll also speed things up. So let's say I have a client who hasn't gotten a pre approval yet, but on paper, they look kind of solid. It should be fine and we put an offer in, we go pending versus a client that's already been pre-approved. How long is it going to take you to do your due diligence or your underwriting on the person who hasn't been pre-approved versus has been?
The style is the same, whether you're
Mm-hmm.
pre-approved or you're not pre-approved. I still have to go through. I got to pull your credit. I got to look at all your documentations. We ask for everything up front. I want to see your pay stubs. I want to see your T4s. I want to see your down payments. Review everything. So someone who already has a pre-approval of 400,000, they've probably gone through that process already. Okay.
Mm-hmm.
So when they come to you, 400,000. And if someone comes to you and it hasn't been pre-approved and says, I want to look at something at $500,000 now, you're going to go out there and do that, put the offer in, It goes live. They come to me and they're only approved for $300,000. So a pre-approval is essential to make sure nobody's wasting their time. Some people, I've turned them down. Well, I haven't turned them down. I've told them, listen, yeah, you qualify for $500,000, but what else are you going to do? You're going to just buy a house for $500,000 and then you're going to just sit in your house. You don't have any extra funds to go anywhere else, right? So I always give them that advice. I'm like, it's up to you. Your final decision is your decision. But I just want to let you know, you have enough money for this house, but do you have enough money for your other bills? Car
Yep.
bill, insurance, going out, you want to go on a holiday, or are you just going to sit in your house and just be happy with living in a wood
Sleeping on a
structure?
futon that your mom gave you. Yeah.
Yeah, right. No furniture, no nothing like that. So, but yeah, no, pre-approvals for sure are highly recommended.
If I'm talking to a brand new client, I always ask them, like, have you been pre-approved yet? That's my first question. Again, to save everybody's time, not just mine, but there's two. If they say that they haven't been pre-approved, I'll refer you, of course. And then if they're like, oh, we don't need a mortgage broker, like we're fine for our finances, how are you going to pay for this? They're like, well, with a mortgage, but we're going to put like a lot down. I was like, okay, well, unless you are paying for this in full with cash, get a pre-approval.
Yeah, yeah. And people that have multiple properties, I always suggest getting a pre-approval because now you have debt. You're carrying on debt and adding on debt on top of that, right? So it's always good to go through that process. Say, okay, what's my affordability? Unless you're going to sell your prior assets to gain another asset, probably a lot easier. But a lot of people now are not really selling their assets. They're keeping it because they want to build their portfolio.
So if I provide you all of my documents to get a pre-approval, like my T4s, all of that, how long is it going to take you to determine my purchase price?
Typically, turnaround for pre-approvals for us is around 24 to 48 hours. We want to make sure because we can, we get the certificate from the lender, say, hey, listen, your client's pre-approved, congratulations. But again, all pre-approvals are conditional. They're not unconditional pre-approvals because again, they have to go through the full underwriting process of the lender. And if it's less than 20%, it's going to go to the insurer. So the insurer is the people who back all mortgages and safeguard the lender in case the borrower cannot pay. So if the insurer takes it on, you're good to go.
I want to run a little math question by you. That is what you do every day. So let's
Yes.
say that my household income is 120 grand a year.
Yeah.
Assuming that I have good credit and no other debts, what would be my purchasing power if I had a $200 a month car payment versus a $400 a month car payment?
Okay. So if we're going to say $120,000, say you have a couple of credit cards, but you pay them off every month. Great.
Yep. Yep. No, I'm
But now,
clean financially, other than my car.
Right. So say, for example, $120,000, we'll say $400,000 your purchase price with a $200 loan over 25 years. Okay. If you add an extra $100, you'll probably just drop your purchase power by say maybe 10 grand. And then on top of that, you can always offset that by just adding more of a down payment.
I've heard somebody say the ratio of $100 a month car payment affects, I think what you said, like 10K worth of purchase power, just for like a really rough ballpark. So if you're paying $800 a month for your car, which a lot of people are, like that's 80 grand purchasing power you're losing. Like,
yeah, we see a lot of those car payments. People are buying brand new trucks, $1,200, $800, $900, and it really affects them purchasing their dream home, like what they want. Because you just think, oh, well, it's only a car payment. It's not that big of a deal, but it is a big deal.
Yeah, because the lenders, they only look at your monthly expenses. So it doesn't matter that you only have $1,000 left on your car payment because they're still seeing $500 a month as a liability. You can refinance your car loan, which will extend the term that you owe it, but your monthly payments will go down, which will free up some purchasing power room for your house.
Less debt, more purchase power. The higher monthly debt you have and you are retaining every month, the less you can buy because they're taking into consideration the property tax. The property tax is a huge thing. In Edmonton right now, like we're seeing, property taxes are really high compared to other provinces.
Fixed rates versus floating rates. What is the difference between fixed and floating? And are they tied to different things that determine what number they're at?
So fixed rates is based off the Canada 5-year bond rate. Okay. And the Canada 5-year bond rate fluctuates due to external factors like the American economy, basically the global economy, right? Our items that we send out for export, our imports, immigration, unemployment, everything comes to play with that. And so that's what our fixed rates are based off of. When we talk about the variable rate or the floating rate, as you call it, we call it variable rate, that is based off of what the Bank of Canada lends money to the bank. So right now, that's a prime rate, right? So the prime rate is 5.45. It just got lowered, right? So now that is lowering the cost of borrowing from the bank. So when they take the money, they have their spread in between. And that's what we get as a variable rate. Now, with variable rate, when people go into variable rates, a lot of people who are on variable rates are seasoned investors because they're buying and selling property. When you're on a variable rate, there's less of a payout penalty compared to a fixed rate.
I was speaking to a different mortgage broker, and she was saying that if I was on a variable rate, that I could switch to a fixed rate. But if I was on a fixed rate, I wouldn't be able to switch to a variable rate unless my term ended.
Yeah. Because on a floating rate, your interest is up and down.
Mhm.
With some of the lenders we choose, like say, for example, you're at 5%, your payment's $1,000 on a variable rate. Now, say if the variable rate dropped by 0.25%, then your payment would drop as well. So your new payment would go down. Some of the bigger banks, they have a fixed on a payment on the variable side, except your interest will go up and down. So at the end of your term, you won't really know exactly what your interest is at the end of your 3-year or 5-year term. But on the fixed rate, from day one to the end of your term, you'll know exactly how much interest you'll be paying.
Mm-hmm. And as of right now, because as you said, they'll change just about daily a little bit. What is the best rate you can find for a 5-year term for floating versus fixed?
If it's an insured product, meaning less than 20% down for a fixed, we've seen rates as low as 4.19 on a 3-year, right? In this environment right now, we're keeping people on a 3-year rate because we believe that the rates will start to level off and become lower where they were pre-pandemic time. When it comes to putting down 20%, where the insurance is now on the lender side and they're going to pay for it, you'll see a bit of a higher rate. So on that side, you're looking at probably around 4.49, 4.59.
So what did you say, 4.19 versus 4.59? Is that what you said?
Yeah, about 4.49 for because you're putting down more money. You're not paying the insurance premium on it. So this way, the loan is now the responsibility of the bank, not the responsible person who puts less than 20% down and it's backed by the insurer. So the bank don't care. They're like, well, if he leaves, he leaves. We get our money back.
Well, you can answer all of those questions off the top of your head, but I want to know if you did your homework and looked at my email before the podcast. On a $450,000 loan with 25-year AM, what would 25 basis points or a quarter point of interest cost me or save me on the flip side? Assuming, let's say it's like 5%, like for the full 25 years versus 5.25%.
Let's do 4.5 and 4.25.
Sure.
That's the number. That's the numbers I ran from your.
No, I ran 5 and 5.25.
I said, it's really easier because I want to kind of keep it like in the market right now. What we're seeing rates at, right? So for $450,000, and you put down 10%. Okay. Okay, so 10%. Now, at 4.5%, your payments are about $2,350 a month. Okay. Now, if the rate drops to 4.25, okay, your payments are $2,290. So a difference of $58.61 a month.
I did 25-year AM 5% versus 5.25. In total, at the end of my 25 years, it would be a difference of paying $809,000 versus $829,000 all in for my house.
Oh yes, sorry. At the end of the term.
No, it's good to know both like the monthly and like the overall. But a quarter point or 25 basis points could save you 20 grand. And of course, they will fluctuate. Your terms will fluctuate. So
exactly.
But just to give an example of even a quarter point can make a really big difference.
Huge difference. And even now we're seeing people on 5.25, 5.65 a few years back when the rates started just going really high. They're refinancing their properties because it makes sense to them to drop the rate now to at least a 1% difference on a $700,000 loan. That's a huge difference, you know?
Yeah.
And we see a lot of people now also taking the initiative of doing lump sum payments, doing accelerated payments.
So that's something that I wanted to ask is how can we speed up paying off our loan?
So the banks give you privileges, meaning you can put down lump sum payment options during the year. So say, for example, you have a 3-year term. Each year they can say anywhere between 10 to 20% of their original mortgage amount, you can put straight onto principal. Okay. It can be the lump sum payments or you can make gradual payments over the 12 months. Okay. Another option is people do accelerated bi-weekly or semi-monthly payments. And what that does is basically you're putting one extra payment or two extra payments onto your mortgage. And you're going to just reduce your amortization. So say, for example, you start off at 25 years and you're doing a bi-weekly accelerated payments. By the end of your 5-year term, instead of being at 20 years, you might be at 18 or 17 years, right?
Mm-hmm.
And that's how people pay off their mortgages a lot quicker.
Yeah.
Just by accelerating payments and just using the options that are provided. It does help with that one extra payment, right? What I advise my clients sometimes, I'm like, listen, if you want to make that option, and I personally do it myself, is I take that extra payment I want to do every month, I put it in a high interest savings account. And at the end of the year, I've made a little bit of interest. I've taken that money and I'm going to use a lump sum payment option. That's going fully onto the principal.
And you mentioned there's a cap on how much of the size of a lump sum you can contribute.
Some lenders are 20%. Some lenders are 15%. It just all depends on what the lender's policies are.
Yeah. So typically
we're seeing 15%.
So if I am making a ton of money and I don't want to pay a penalty for, paying my mortgage outright or putting even more than 15% down, I could just put my, I don't know, $100,000 in a high yield savings account, let that marinate, as I say. And then when my 5-year term comes up, when it's time for me to refi, I could put all 100K in there and then there wouldn't be any penalties for me exceeding that cap.
Yeah. So say for example, January 1st, you're done your 5-year term. You're going to renew, right? What you can do, put like you said, a lump sum on that mortgage. So when it comes time to renewal, the new renewal is not based off of what's left. It's what your new mortgage rate is going to be with whatever lump sum you put in. Say, for example, you put $100,000, you owed $400,000, and you can put $100,000, you have a $300,000 loan. So obviously you're going to save a huge amount of interest on the remaining amortization of your loan. And with the new term and interest rate that you're going to get from your lender.
Awesome. Something that you and I have dealt with a couple times now on the residential rental side, having duplexes that have one title versus two title. And we've got hit by this a couple times and got misled on the last one, which broke my heart. If you're looking to get 4 doors, obviously a duplex with legally suited basement is a great option. But why is it important for you on the financing side to make sure that that property is all on one title versus 2 titles?
Right. So obviously we know duplex is 2 different suites, 2 different things, but they're side by side, they're connected. When it's under one title, it's categories as one property.
Yeah.
Okay. So the bank is just lending on one property. When you have 2 separate titles, it's 2 separate units. So you could typically go, yes, I'm going to owner occupy the first one at 5%. But in the second one, because of the second title, you have to put the 20% down because you're not owner occupying it. It's classified as a rental. And on the one title, all 4 units, you're owner occupying one. The other 2 can be as a rental for you, but it's still classified as one contained structure. But it's under one house. That's it.
Let's say that there is a duplex with legally suited basements for around $800K. If I'm prepared to put 20% down anyway, because I'm not going to be living there myself, it's purely a rental property. Does it matter then if it's on 1 or 2 titles?
Well, yeah, because again, if it's 2 titles, 2 separate mortgages.
Yeah.
So the bank is going to look at it. Well, okay, the first one you're going to do is a full rental. They want 20%. You want to do the second one, again, it's 20%.
Yep.
You can't get away with that.
No.
But if it's one title, one person living in the person purchasing it living in one unit, and the other 3 are going to be rentals, it's fine with the 10% because you are living in there. And we have the flexibility with lenders guidelines, insurance guidelines, they allow that. So
which is a very smart move that a lot of people are looking to do. Just more doors you have, the greater your income is going to be. How does rental income affect a residential property?
Like say if you're renting out your basement and you live upstairs and you're trying to purchase something like that, in fact, it helps you. Typical lending banks like say RBC, CIBC, TD, all of them use say 50% of rental income to help you qualify. Us brokers.
So what does that look like? Like if I'm renting out my basement, just easy numbers for $1,000 a month, then What does that $500 go towards, that 50% of rental
It helps
income?
you qualify for the property.
So that
Because
gives
right,
me $500 worth more of like
additional,
my
yes,
income?
yeah. So it helps. So for your
Okay.
purchasing power. So say, for example, you want to buy a single family home and you only qualified for $500,000.
Mhm.
Okay. Now you're gonna go get a single family house with a rental suite in it, and you're gonna make $1,200 a month out of that. That's gonna help you qualify for a lot more. Now, say that property is worth 650, you would probably qualify for that because you
Okay.
have that guaranteed income coming in. The bank is looking at that. As long as it's a legal suite, they're gonna be like, well, that's great. We have that money, and that's gonna help you cover your expenses for that unit. But
Mhm.
the downside to that, higher insurance,
Yeah.
higher property tax,
Mhm.
right? So it kind of balances itself out.
And you have to be a landlord, which is not passive. Regardless of what they tell you online, it is not passive to be an
Yeah.
investor.
No, no,
Mm-mm.
no, no, no. We have a few myself, and let me tell you, it's always a headache.
Fun story. So I was leaving my house one day and I walk outside. I'm heading to some showings. And then I hear like, "Hey, you." And I turn and it's Shabir like parked at the front door. And I literally just went, "What the fuck are you doing here?" I was so confused. And you thought I was doing a showing,
I
but
thought you
I
did the
was just
showing.
leaving.
Yeah.
Yeah, and it turns out your mom lives in the same condo building as me. That was just so funny. I was like, what is the coincidence of that? I had no clue what you were doing there. I was like, what? That threw me for a loop, but that's pretty funny. Small world. Bridge loans are used all the time. And I know a lot of buyers, when they hear bridge loan, they're like, what does that mean? Like, what am I getting myself into? So, when do you see bridge loans get used? I mean, they can be used for a lot of things, but typically, what are the most common uses?
Typically is when a client is selling their current property and buying another property, and the
Mm-hmm.
closing dates are different. For example, they sell their property, um, and that's not closing till the 30th of the month, and their current property that they've just bought is closing on the 15th of the month. So we
Mm-hmm.
have to bridge the gap from the 15th to the 30th with the lender so that there's enough money, because a lot typically people are selling that property to use it for the down payment. So the
Yep.
bridge loan comes into effect to just bridge that gap.
Yep.
And it can be as long as you want. It could be 3 months, 4 months, 5 months, whatever. But you're just going to pay for it. And it's
Mm-hmm.
a daily compounded interest.
What does that actually look like?
There's a fee. So like a $400-500 fee to set up the bridge loan. And banks usually will do that for you.
Mm-hmm.
And on our side, we facilitate that as well, either with the lender we're using or a different lender just to bridge that gap. And then rates are typically, so it will be prime plus a couple of points above that. So say prime is 5.45, and we can just say the bridge loan interest rate is going to be an additional, say 2%. So your
Mm-hmm.
rate would be 7.45
Yep.
just for those that time of that gap,
Yep.
right? I just did one for 4 days. It cost the client a couple of $100.
Yeah,
So
but
it's,
they got them their house.
well, yeah, it just because the purchase and the selling wasn't at the same time or a day after. Typically, we would like to see it let that property go, and then the new purchase will take over a couple of days after. So we have the funds with the lawyers, and everyone's happy with that. But again, it's an option that a lot of people use, a lot of our clients use. It's just because nothing ever goes to plan. We'll
Yeah.
just
And
a new
another really common product that people use both on the investment side and for primaries is a purchase plus loan. What is a purchase plus loan?
So what people are doing with the purchase plus loan is they are buying a property and they want to say they want to do their basement up and make it a legal suite. They're trying to get additional funds to finish off the basement and incorporate it into their mortgage. So that's what improvement plus mortgage typically is. Just to, or they want to, they're buying a rundown home and they're going to renovate it and they're going to own or occupy it. So the banks are going to go on the future value of that property to qualify them and give them that additional funds to fix it. But what they do is they hold that money back, and there's some requirements like they would have to get a contractor, you have to get
Yeah.
appraisal beforehand and appraisal after.
Contractors will have to provide quotes to ensure the bank that if I am asking for an additional 50 grand to do X on my house, that
Correct.
the work will actually cost 50 grand. They're just not taking my word for it. There needs to be proof.
Oh, and they'll come and take a look. They'll
Yeah.
sometimes they'll send out the appraisers. Appraisers takes pictures and everything, send it back to the bank, and then the bank will sign off on it and release the rest of the funds.
Mm-hmm.
Right? So those ones are there's a lot of it coming out, and there's even a new program that's come out as January 15th. Now it hasn't rolled out yet.
Yeah.
It's been implemented. We're still getting a lot of information on it. Which lenders are going to go and take this? It's like a secondary loan on your property, but that is to help people make a secondary suite. The governments have approved that type of program, and they have money set aside and everything like that. We're just waiting for banks now to come on board and see what type of guidelines they want. And it's a relatively low interest rate. I think we're saying around 2%. I think the max you can get is up to like 2 million value of the property. The value can't be any more than a certain amount, and you have to use that suite, that money strictly for that suite and thing. But this stuff is still rolling out, so there's a lot of questions around it, and there's not straightforward answers. It's like a generalized product that's come out.
So in general, they're basically making it easier for you to get a loan to put a second suite on your property.
Yes, exactly. Yeah. And that's been going on for a while because, again, housing is an issue in Canada. We have a lot of people moving here, so they had to implement some kind of strategy to help for the increased population. And secondary, obviously you're building equity, and people want this kind of things. People don't have 80, 100,000, 200 to do these kind of things. So obviously, go to the bank to get a loan. And typical ways you're trying to do would be a home improvement loan or something like that, or they would call it a second mortgage. And not many people could qualify for that. So this kind of program helps them, knowing that it's going to be, again, like a typical mortgage, but it's just separate entity to what you currently have, because you're just doing it for your property to increase the value and obviously make money out of it. So we have to see what the insurers have to say about it too, because they're involved in it. So you may see and what type of guidelines they're gonna ask about this program and what they're gonna give us and let us know. I'm hoping they'll have something here shortly because they just rolled it out. They approved it on the 15th of January. It's only 3 days ago, 2 days ago.
2 days ago. It's
2 days ago.
fresh.
Yeah. And I've been emailing and asking people like, we don't know. Whatever the generalization on the CMHC website is what you get, but I'm like, that's not enough. Like, I need the ins and outs. I want to know the ins and outs, but nobody has that answer currently.
We talked a lot about using this secondary loan for basement suites, but do you think I could use it to put a garden suite or garage suite in my backyard?
I'm not too sure about that. I think it would probably make common sense that you could do that, but again, permitting issues. Are you allowed to do that? You're more likely to get a basement suite than a garden suite, depending what area you live in, right? I know for basement suites, there's a hot demand for people to convert their basements into legal suites.
Well, those are all of my questions for you, Shabir. We did
That's it.
Yeah.
That's it.
That's all I had for you. And then I'm sure I'll have you back and we'll just, we'll pick your brain even more. But I think all that information was really good because it's applicable to both primary homeowners and also investors. How can people reach you?
I have a website, www.mrmortgageloan.com. My online application is there. Click on it. You can reach me by phone, 780-707-9551. And you can Google my name. All my information is there. If you just want to have a conversation, I'm okay with that too. Doesn't necessarily mean you have to take a mortgage from me. I'd love it. But if not, I'm always here to help. Doesn't matter.
Awesome. I just have so much confidence when you say a deal is going to work or a deal isn't going to work. Like, I know that you've looked at everything. Yep.
I appreciate
just hyping you up there.
Oh, I love it. I love it.
Yeah. Well, thank you so much for your time, Shabir. We covered a lot of stuff today and we could go in so much more detail, but I think this is a really good conversation to just talk about different mortgage products and how it works in general for people that are new to this industry. I'm so glad that I get to promote my friends on my platform.
And I'm so honored to be on this podcast. It's amazing to work with you as well. You're just an amazing person as well.
All right. Well, till next time.
See you, my friend. Take care.
Bye. Thank you again to Shabir for joining me on this episode. I always enjoy speaking to him, and I really hope that you learned something. If you're looking to reach out to Shabir directly, you can do so through his email, phone number, or website, which will all be in the description below. If you liked this episode, then actually like this episode and subscribe. I really enjoy creating content for you guys, and your support makes it that much more enjoyable. There are some really cool topics that we're going to cover in future episodes that I am super excited to share with you. You do not want to miss out. Trust me. Thank you for sharing your time with me. I hope you have a great day. Bye for now.